back to Primary Source China Investment. This is show X5, and Peng Guo and I are here to talk about our year-end review and preview, talk about some of the things we discussed at this point last year, and see what we got right, what we got wrong, and where we might be going for 2024. So we talked about three themes last year at this time. The first was renminbi dollar. The second was on the equity side, financials and technology. And the third thing was China's consumers. What would they be doing? Let's kick it off with financials and tech, because we spent a lot of last year in general imploring allocators to do two things. One, buy A shares, not Hong Kong or US listed names. And two, hide out in financials, which offer lower PE and high dividends. So first up is financials, and specifically banks. The bank index on the mainland was down, but down less than the overall A share, the CSI 300. And if you add back about a 5% dividend, you outperform the CSI 300 by about 10%. So you were down, but you were down less, and you got a nice dividend. As for tech, we've been saying avoid US and Hong Kong listed tech, and instead go for A share tech and telecom. So US Hong Kong tech is captured by MCHI and KWeb. We talk about those a lot. And those were down about 15%, similar to that of the CSI 300. However, if you look at A share tech and telecom, it had significant outperformance with an average of about 15% up, which would give you about a 30% outperformance. So Peng Guo, what are your thoughts on our call for that last year? You feel pretty good about it?
Yeah, I think firstly, still the macro factors dominate the entire market. There's so many unexpected things in the last year. I just realized a lot of the predictions could be wrong, and some of the bigger securities names. So their predictions almost reach 100% wrong for a couple of years. So that is be always prepare for the unexpected. Yeah, you are right. This bank is actually added the dividend back. Its performance better than other sectors. This is not strange because in China there's 16 banks, a big name. They produce almost 40% of the profit for the entire market. Tech is it's really like the big things. It makes the everything almost could be in this area. So you have to spend a lot of the experts to dig out what really should be included and should not be included in this area. But overall, I think in the China financial market, another very important thing is a large cap and the small cap. Those two things are even more important than the sectors in the market. So that's for the 2024. I won't be predicted for that. But most of the people, if you don't want to predict it, just choose the 800, 10,000, or even 2,000, the whole market index.
Yeah, you bring up a good point about crowding out. I mean, the banks are wildly profitable, and this is people may not be willing to pay up for that growth. We talk about it a lot, that the PE for the banks is notoriously low relative to the CSI 300, all those large caps. My point is hide out. So we'll get to that in a minute, but wanted to talk about the second thing we discussed last year. This time was renminbi dollar, the FX, and what kind of rate. So at the end of 2022, the last 6 weeks or so, renminbi appreciated very quickly from about 7.3 to about 6.75. At that time, we said that was overdone and thought in 2023, we would see some moderation around the 7 level. And as we end 2023, I think we're at 7.10 or so, we can call that a win. Many were predicting further RMB appreciation. We weren't. So I would say I'll take that win as well. Any thoughts, Peng Guo?
Definitely, this is a huge topic. It's almost entire China pay attention to this exchange rate. I really there's a lot of factors behind that. Technically, it have some adjustment. But overall, the government really hope like the exchange rate keep a relevant, stable
Stable. Yeah.
range. So they try to maintain or support, or they can obviously they can increase the range, but the relative stable exchange rate really benefit for most of the people in this market.
The third topic we covered last year at this time was the consumer. And here's back to your point, Peng Guo, where everybody got it wrong. Remember, at this point last year, everybody was saying China's going to give up zero COVID. They're going to come out. It's going to be very bullish, a lot of tailwinds. The consumer is going to be very strong. They're going to convert a lot of that savings
That's
into
all
spending.
opinions.
It was all very, very wrong. So both in consumer staples and discretionary, consumers continued to put their hands in their pockets. And those indexes were down about the same as the CSI 300. So you and I were saying the consumer is going to be patient. That's an actual word we used last year at this time. The consumer is going to be patient. And it looks like the consumer will continue to be patient. So you can see year-to-date performance down 14, 18% for the discretionary and for the staples. So again, I would call that a pretty
Yeah,
solid win.
consumer staples is performance might not have, as people expected. As obviously, there's many reasons related to that one. So it's more like the what kind of age people hold the society's wealth. It's more like the 70s.
Yeah,
So those kind of the generations, they already reach like the middle age. They become more conservative. They don't want to spend the money. So it's still a lot of money sitting in the bank, but cannot be used to the consuming and spending. The active, like the 30 years old people, they just don't have too many disposable income. So that's caused the big problem for the current downgrade of the consumptions. So
right.
I don't
Because
know
you
how
have
to
the older
solve the
people that want
problem,
to,
but yeah,
yeah.
it could be lasted for a while.
Yeah, because the older people, they want to conserve their wealth. They're not looking to even grow their wealth. Even if I stay the same in my 70s, I'm okay. As long as,
Yeah. This kind of structure is harder to change. I don't know.
yeah,
Yeah.
yeah, that's great. So what are we thinking for 2024? And I was thinking, in English, we have Chengyu as well. There's a lot of great Chengyu in Chinese, but in English, we have one too. And it's a little bit like chicken and egg. So what I mean by chicken and egg is that A shares are predominantly retail investors, and they're looking for an impetus to buy. Historically, that's been some sort of home team where the sovereign wealth fund steps in, Chinese government steps in, Chinese companies buy their own stocks back, or the sovereign wealth funds. But Beijing has indicated that this ain't happening. So I suspect China equities might bump along the bottom for a while because the Chinese consumer is not ready to step up and buy equities. That could change, but we'd need to see an impetus for that. So if you're an allocator and every month you're putting money towards China equities, I would say stay with financials for the dividend, healthcare for the obvious reasons, and tech and telecom because that's where the entire market growth is coming from.
I totally agree with your opinions. Yeah, the market definitely will be bounced back. The only problem is how high it could reach. Another thing is hopefully next year is get a more relative stable market. So nobody want to get the big increase or big drop. That is a high volatility. It really bring out of the unexpected risk. I don't think people can easily make money from a high relativity market. So try to make things more predictable and more reasonable, and that will benefit for most people in the market.
Well, we'll look forward to that in 2024. We'll be commenting on it as we go along. Everybody have a happy new year, and thanks for tuning in to Primary Source China Investment.
Yeah, thank you for everyone, and good luck and happy new year.